this week we saw another big merger, and it sort of reminded me of the great movie Kindergarten Cop.
It's not a tumor.
Where he asks his class, "Who is your daddy?"
And what does he do?
And in this case, it's global fund allocators and aggregate fee streams.
See, I don't know how to react to that. What am I supposed to say? Sixth Street's the daddy.
Yeah.
L&M's the kid.
Yep.
Barings is the daddy. Artemis is the kid. Mubadala is the daddy. And Fortress is the kid.
Yes.
Get it?
Okay, fair. Welcome back to the Promote Podcast, your insider guide to the money and mania of the CRE markets. Hitan and Will here as usual.
This week we have another crowded docket because the world keeps turning. But two deals that we wanted to highlight that really touch on themes that have been big players in the Promote cinematic universe, which I'm definitely trying to make stick.
You've already made it a thing, I'm telling you.
The first is the continuing aggregation of smaller or mid-sized investment firms by the global mega funds. And then also the continued revitalization and frankly, the revitalization, haha, see what I did there?
I love it.
Of San Francisco with
Greg Flynn, one of your classic men with deep pockets.
Yes, and those pockets are filled with hot sauce from Applebee's.
Fries Supreme, Nacho Supreme. And then finally, the Kushner family, they basically got EB5 approval for that once very controversial project in Jersey City. And get this, it's not even a classic EB5 visa approval. It's financializing the EB5. So you're basically, now you can finance the American dream.
One could argue that financing was the American dream.
This is closer to the pure kind of ideal of America, if you think about it.
I believe in America.
And I believe in financing.
The way I think about it a lot now is that AUM gobbling is all the rage. To stay relevant, you just kind of have to keep getting bigger and bigger and bigger. And we're seeing this play out across the real estate landscape, across asset classes.
Agreed. And frankly, it's something that I think is going to be a sea change in how capital is going to be allocated moving forward, because you had all of these firms which you could have one big programmatic JV and that could drive a company for decades.
Mm-hmm.
If you had one of the big pension funds, one of the big sovereigns. But now a lot of the distress in office, a lot of the stress in hotel, retail, and what have you, and also, of course, Sunbelt Multi, as I'm obligated to say on this podcast.
Right.
Allocators seem to want to be out of the single stock picking game, so to speak. So if you pick an operator and they just do office, and office goes sideways, I mean, you as the allocator are making an investment decision, which opens you up to a lot of potential criticism and job insecurity.
Unless you're a Canadian pension fund where you can post negative returns and very few consequences.
CDP has a new head, and she came out explicitly and said that we're getting away from being operators and we're getting back into being just investors and picking funds.
Right.
And what's funny is that this is almost like, this is a real inside baseball.
That's what we love here. Well, come on, this is the Promote Podcast. This isn't no cap.
It's almost like apartment renovation. When you walk into an apartment complex, you can tell when it was last renovated by what color the cabinets are, because it always just goes back. It's very cyclical. And frankly, this is the same thing here, where it was really hard when I first started private equity. That model was a little bit more challenged because there's a lot of pushback from LPs about paying a double promote. So paying a promote to the private equity firm and then the private equity firm paying a promote on the deal level to a joint venture partner and operating partner. And now people are like, you know what's great? Double promotes. Because it means that if I'm putting stuff into a fund, I'm not making the investment decision. I'm picking the horse. And at the end of the day, you can just say the horse was lame. And who knew? So all this capital is not going to go into sharpshooters at the allocator level. It's going to go into the mega funds, which then have all of these branches underneath it.
Yeah. So they will throw money into all these different strategies, different operators, right? And that's why we're talking today.
You want to be the Sandy Weil full supermarket of options.
In this case, I'm missing having a platform that focuses on affordable housing. So I'm just going to go buy into one.
It's a lot easier than having to go build it yourself. I mean, again, Comparado talked about it where they're buying this agency license because it's really hard to spin up that business.
Well, he had a great line about sitting down with David Brickman, CEO of Freddie Mac at the time, and saying, how do we get one of these licenses? And Brickman just laughs at him. We're basically talking about moats.
Yeah, it's the same thing here. It's I want a big fee development business for affordable housing. Cool. You can go try to start that and it'll take forever and you'll have to hire 1 million people and it'll be very execution dependent, or you can just go buy one.
You can just go buy one. And I think even if you started it, even if you had the capital and the patience to go ahead and try to break your brain on this kind of thing, there's another component here. I call it juice. To do affordable housing, you need to have immense juice. You need to be like connected up the wazoo with leaders in that city or state. And I think Ron Moelis is one of the most connected men in New York.
Yeah.
L&M is one of the premier affordable housing players at least in New York. They own 15,000 units across kind of the 5 boroughs. 80% of them are income restricted. And it's a very particular game, right? We talked about this a little bit in an earlier episode about the related CPC partnership to take over the Signature Bank portfolio via the debt. But to understand these places and to understand kind of the stakeholders to make these deals work is incredibly complicated. There's a lot of alpha in knowing that process.
Absolutely. There's a great Twitter account, Reset Basis, Marlo Stanfield, who talks about this. And it's not like you can just show up and start building affordable housing. It takes, as you said, a lot of juice, but also just a lot of know-how. I mean, there's so many programs. They're always shifting. You look at the cap stacks for these things.
It's almost like death by complexity, right? Like you have to, the pain tolerance, we've talked about it with Barnett. This is its own kind of rite of passage where like, we're going to throw all these regulatory hoops at you, right? And you're going to have to figure it out.
Absolutely. You look at the cap stack and there's like 9 different sources of funding here. I mean, each one of them has their own process. So it's not something you can just step into off the street. And so very interesting to see 6th Street get into this space.
I see what you did there. Nice. Yeah. So can we cook a little bit on 6th Street? So the guy running point on this deal is interesting. So we're talking about Marcus Alvarado.
Yeah, he was at Starwood for a long time, very successful there. Then went over to Cadre.
Oh, God.
RIP.
Did he join Ryan Williams in the 150 push-ups, 150 sit-ups, and 5-mile run every day?
Honestly, that might have been why he didn't last as long and went over to Safehold. And then ended up taking the job to sort of run real estate at 6th Street. And 6th Street, which was the credit arm of TPG, and they spun out. Real estate had been a little bit of a blind spot. And so you can't do better than hiring someone of Marcos's caliber who's worked at the highest levels of private equity, ran a public company.
The Chorus deal, you've talked about in a previous episode as being hella lucrative.
That deal was tremendously successful for Starwood Capital and had a lot of complexity. So if you're 6th Street, this is the type of guy that can build your real estate business.
What's attractive here? So affordable housing, big business, pretty moody, as we've just said. How do you make money in this business?
The fee streams here can be really lucrative if you are a player at scale, because you get these development fees or developer fees for each of these projects. And so if you're doing this at scale, it's just dev fees coming in left and right. And that's almost more important than the deal's actual cash flows. And so you just keep putting these things together, and you basically have an opco that's generating a ton of EBITDA.
Oh, I see.
As opposed to relying on the property cash flows to generate your returns.
We've talked before about how development is such a painful game because there's so much uncertainty before you kind of hit the gravy, right? That's been one of the themes of this podcast. This seems like the opposite. Like you're making money as you go.
You're making the fees up front. Yeah. And again, it's not like you can just show up and say, "Hi, I'm an affordable housing developer. Pay me a $3 million developer fee." Like it takes a lot to get there. But if you have the machine built and you can supply it with capital, then these things can be incredibly lucrative.
Steve Ross parlayed the affordable housing game into this mega empire, and now he owns the Dolphins and sold a stake and is doing quite well for himself.
I'd say he's doing extremely well for himself. And this is 15,000 units they own, 80% are income restricted, as you said, mostly in New York. So maybe you take this national and in a bigger way than they already have with 6th Street's global reach and sort of unlimited deep pockets. And it could be a really amazing, predictable fee stream, which again is sort of the holy grail of these types of businesses, is you want to have predictable earnings, not the lumpy promote, which is sometimes hard to come by.
One of the things that I think about when we're thinking about scaling a business like this nationally is, again, the political juice. Ron Moelis was so deeply entrenched in the New York City power politics. There's a legendary exchange in one of these Crane stories where he's talking with then Deputy Mayor Alicia Glenn, And she says, she's flying back from Shanghai, and she writes him that she was, quote, dying for a hamburger and a bottle of Montrachet.
I barely know what Montrachet is.
It's a semi-decent wine. I don't know. But you'd have to develop those kind of relationships in markets that you might not have the name recognition. There are like complications to, even though it's a giant platform in New York, go to Chicago, whole different landscape of players, whole different set of problems, right? So there's so many things to navigate.
Yep.
So zooming out, we're seeing L&M 6th Street. It is a big deal, a very consequential one. But I think it's part of this broader wave of real estate M&A that we're seeing all over the place. So Barings and Debbie Harmon's firm, Artemis, right?
Yep.
Blue Owl IPI was recently, Ares GLP's platform. And so this is all kind of AUM chasing, and you need to keep getting bigger and bigger. Fortress's co-CEO, Drew McKnight, basically explicitly said this, and he said the following. For us to compete with larger firms like Ares, Apollo, and 6th Street, we need to continue to grow assets. Because if we don't, then we'll be less relevant. And we've talked previously about Apollo, the kind of the innovation they found by unlocking the insurance space to grow their assets and then have more capital to make bets.
The worst place to be in anything almost is in the middle. And if you're a firm, frankly, like Fortress, like you're in the middle. If you're a firm like Artemis, like you're in the middle. And the capital is going to go to the biggest firms with the biggest brand names that offer the least amount of career risk. So I think there's really two ways to go. The one is you get bigger, you get bought, or you go the other way, you become an absolute sharpshooter and you put together these assets for these firms at scale that's big enough for them.
You talked about the capital kind of flowing to the very top, and we've seen there's like I don't have the stat in front of me now, but the 6 largest private equity shops have raised like an overwhelming share of the capital in these spaces. Like they've basically taken a bigger and bigger slice of the pie each year in the last 5-10 years. That's
absolutely been the case. It's going to continue to be the case. And there are firms that you would be shocked that couldn't raise the capital that are having trouble raising capital. And there are a number of funds that are going to be smaller than their last one. There are a number of firms that aren't going to be able to raise the next fund. There are firms specifically that are out of business right now, and they're just sort of a zombie.
Meanwhile, Blackstone's raising like their $30 billion fund. Brookfield's raising a $16 billion fund. It kind of keeps coming.
Right. That money's going to go somewhere, and you have to have the full poo-poo platter available for folks to be attractive. Because again, like after the carnage we've seen in specific asset classes over the last 5 years, people just do not want to take single sector or single market risk.
San Francisco is one of those places where if you grow up outside the US like I did, you have this incredibly romantic view of it, right? It really meant something for the longest time.
You got to just stop saying that you watched Basic Instinct 1,000 times when you were a kid.
Maybe I was just guessing.
I've seen it way too many times. That's why I'm as messed up as I am. But, you and I talked a couple of weeks ago about New Bond and the big hotel bet with the Hilton, the mega Hiltons there. Mm-hmm. And, you kind of find yourself rooting for San Francisco, kind of like New York. It's nice to see people actually betting on the city again.
You think about San Francisco, it's the cradle of so much innovation that has driven the way we live today, for better or for worse, I guess. And it felt like it couldn't get out of its own way the last 5 years. There have been so many negative headlines. And frankly, a lot of times these headlines are sensationalized. They were not about San Francisco. Like, it really was awful. Like, if you were on the ground there, like, it was not great.
And I'm not an alarmist. I'm a huge city guy. I want the best for all these places, but it was terrible.
Oh, it was not good. It was very, very bad.
Yeah.
And they've got a new mayor, and he is, again, figuring out that you just got to you got to make your layups.
You got to crack some skulls. You got to clean the streets, and everything else will come.
There's like 9 people in San Francisco who matter. And so if you just do the thing to like makes them happy, it makes everything easier.
Well, one of the people who matters is a guy we're going to talk about, the restaurant mogul, Greg Flynn.
I believe they call him restaurateurs.
I never know if there's an N in that word, so I basically stopped using it. But Flynn I think he owns like thousands of Applebee's, Taco Bell's. He's a king of fast food.
Yeah, he is one of the largest franchise owners in the world, but he also has a very large real estate portfolio with Flynn Properties. He has a lot of hotels. He's been in office, and he's been really active in buying San Francisco over the last few years. And again, just to put some numbers on this franchise operator, he has almost 3,000 locations between Applebee's, Panera, Pizza Hut, and other brands.
How many calories do you think Greg Flynn serves in a single day?
I think a lot, but he also, I got to say, he looks phenomenal.
He looks great.
Clearly he's only eating at Panera.
So you and I have talked about, this is one of your concepts. I got to give you credit, which I love and I've stolen for the promote. We call it men with deep pockets, right? Guys who don't have to worry about nitty gritties like cash flow, and they can just buy on basis. They can buy on, okay, that looks like a pretty good price. So Market Center, the transaction we're talking about today, Flynn and his partner DRA are paying $240 a foot. The previous owner, our guys, Paramount Group.
Oh boy.
I can't say that name without laughing anymore. But Paramount Group paid just under $1,000 a foot for the same property.
It is.
So there's a massive discount to be had in SF if you're willing to move.
So just again, to put it in like stark numbers, Flynn's paying about $177 million. Paramount paid $722. So I got into real estate to avoid math, but that is a big difference.
That is a huge difference.
This is not the only deal that he has done in San Francisco recently. He bought the Huntington Hotel, which is a beautiful, like stunning old hotel in 2023. A lot of people like to make fun of, who's the best investor in the world and saying that it's Nancy Pelosi. Well, guess who's an LP in the Huntington Hotel in the Class B office building he bought on market?
Oh, God.
It's Nancy and Paul Pelosi. So get on the train because these things are going to the moon.
We choose to go to the moon.
So this property, Market Center, is only half leased. So there's a lot of work to be done.
I think that's the opportunity, though, is because he is resetting at such a low cost basis. This is, again, not dissimilar to what our good friend Peter Hungerford is doing with New York Rent Stabilized Multi.
Hashtag drop the mic, MIKE.
The thing is, it doesn't matter. The cash flow doesn't matter as much if your basis is 77% less than the previous owner, because what that means is to hit his returns, Flynn can he has a lot of levers to pull. He can offer lower rents.
And he's talked about TIs too. He's like, we're going to go all out on TIs.
He's offering massive tenant improvement packages. And I think what's really under the radar about this purchase and why I think it seems really appealing to me is the office suites on average are 13,000 square feet.
So you don't need like a financial trading company or some...
You don't need to go get Bank of America to take 400,000 square feet for this thing to work. You can do it with like blocking and tackling with these pre-built suites for folks like small law firm, small investment firm, all of these different types of things. And what it also means is that tenants can grow in the building. So if you have a tech firm in a Series A take 10,000 square feet and then they blow up, maybe they take half the building, and that's the whole deal. Like, you basically give yourself a ton of shots on goal.
And to that point, like, look at the quality of tenants. Okay, it's only 50% leased, but look who's in the building. Waymo. He's got like the most exciting company in the world in his building right now.
Sam Altman might have something to say about that.
So what do we know about the partner here, DRA? I've noticed a couple of purchases. They spent like 200 odd million on a portfolio from Blackstone. They bought some Chicago multifamily last year, but what's their deal?
Just big fund manager. I think they're on their 11th or 12th fund, several $1 billion a pop, very experienced in office, very deep pockets, and have had a continued ability to raise money. So I would say what's interesting is it's Flynn's first deal with them. So new capital partner for him. But I think also he's got a pretty compelling thesis here because there's no one more local than Greg Flynn. And he's got a history of doing this type of thing and buying distress. And he's very hands-on. So it's good to see for San Francisco to see new capital like DRA coming into the market.
You make a point that I really love, which is he's local. There is something about like if Greg Flynn buys these buildings and brings SF back, there is something like I would imagine he's having conversations with Mayor Lurie and all of that.
I would only imagine that that's the case, but he's San Francisco to the core.
Through and through.
And again, like his whole empire was started by his dad's Burger King on Van Ness. So he's got long and deep ties to the city. And so
this could be like a mayoral run platform at some point too.
He's the type of guy who runs for mayor, except for the fact that they already have a, billionaire
they do.
Mayor.
Who the industry loves quite a bit right now. Mr. Mayor, if you're listening, hop on with us at some point. You're seeing kind of similar stuff play out in New York as well. We've seen people snapping up unloved buildings at a very, very, very compelling basis and thinking, well, if the price is good enough, I can do something with this. I can either wait this out or I can invest the money in TIs and capital improvements and all that.
What I would say, though, is there's a little bit of difference between someone like Namdar and someone like Flynn, where Namdar is going to milk this for cash flow. They're just buying stuff cheap and trying
Yeah.
to, fill it however they can.
And they go back to Great Neck. They don't have to worry about it. They're not.
But Greg Flynn is going to invest a ton of money in these things.
Yeah.
Whether or not they lease, who knows? He has a lot of experience in hospitality, and that's something he really plays up in this acquisition. He's like, we're going to bring a level of hospitality to these office buildings that hasn't been seen in San Francisco. I think that hospitality is less important than the most generous TI packages that San Francisco has ever seen. It is good marketing, and it plays a part in leasing. So
speaking of TIs, a bit of a tangent, I'm sorry, but speaking of TIs, have you ever checked out Ken Dart's building downtown Manhattan?
I have a lot to say about Ken Dart.
That is a mystery and a half. We'll save it for next time. I guess one point I want to make is that this strategy of kind of buying at the bottom and seeing what you can do with it, it makes sense in a city like SF, which has the bones to be great, was once great, will probably come back. New York can make sense as well, but you're seeing buildings trade for less than nothing in places like Seattle. In other markets where kind of the comeback story isn't as sure thing.
Well, New York and San Francisco and a handful of other markets have rent elasticity, which other markets don't. And so if you're buying basis here, $278 a foot, office rents in San Francisco, I think were like $100 a foot not too long ago.
Yeah.
So people bandy about replacement cost, and we talk about buying on basis or buying below replacement cost. Replacement cost doesn't mean anything if no one wants to replace it. And in San Francisco or New York or Miami, like, people want to replace stuff. So if you're buying below replacement in an area where people actually, want to be, that's the juice.
You might just have something. I'm an immigrant. I came via the H-1B visa. Others have chosen to come via the EB-5 visa, and developers have always loved that, right? That program, which is colloquially known as the Cash for Green Card program, has brought in billions of dollars for some of the hottest development projects in New York, Miami, Los Angeles. It's been an incredible deal for developers because it's been like way cheaper than traditional mezz. It's been a not so great deal for the investors themselves.
Unless you really needed to get into the US.
That's true. But there's been a lot of controversy about this program forever. The minimum thresholds for investment were raised. There's been a lot more restrictions on the program. There's been a lot of concern about gerrymandering. And President Trump had talked about killing it entirely and replacing it with what he called, I believe, what was it called? The Trump Gold Card.
My only thing about the Gold Card is that if you need to spend $5 million to figure out how to get into the US, like, the people who have that much money, like, presumably can find a cheaper way and a quicker way to get there.
Just go to St. Kitts and Nevis.
Yeah, it's just ridiculous.
Anyway, so that's kind of the background for this. But what's interesting here is that Kushner companies, Charlie Kushner, Jared Kushner, who's President Trump's son-in-law,
Nicole
Kushner-Meyer, there was a huge controversy the last time around when they went to raise EB-5 funds for this project. Massive. I believe what happened was Nikki was in a room with Chinese investors and kind of alluded to her brother's then White House role during the fundraise. It was a big no-no at the time. They actually pulled back from soliciting EB-5 funds for this project. The second Trump administration, the lines are completely redrawn.
It's just sort of emblematic that something that was radioactive, 7 years ago is now sort of going through without any sort of scrutiny.
So what they've just received is approval for a new structure, which is EB-5 visa green card petitioner. So your immigrant from China, India, wherever, has to just kick in $500,000 up front, and then they can finance the rest. So you need about $800,000 to hit the minimum threshold for an EB-5 visa. Now you only have to put $500,000 up front, and then you can get a loan for the rest. So you're financializing the American dream.
And I would argue the American dream is financialization. So we're when people are coming in, we're getting them off on the right foot.
It's unbelievable. But what's interesting here, again, you and I, the promoter in general, is fascinated by middlemen. The Kushner part is fine. It's interesting. It's politically charged, whatever. But the guys that came up with the structure are Nick Mastriani's U.S. Immigration Fund. And they pulled in hundreds of millions of dollars in the EB-5 heyday. And they've come up with this new structure, which might give them an edge over all the other regional centers.
He's made so much money. And frankly, like, the risk-adjusted basis on which he has made his money is out of control. It's like pod shop-esque Sharpe ratio. So it's really interesting to see him back with a new structure. And frankly, like, again, not to be political, but like, if the environment is different. He's taking advantage of it and is able to do this. It means a lot. Like, it means a lot of projects are it's hard to make stuff work right now. So this old, new type of financing is back. A lot of these things can get off the ground now.
It's basically 500 now, and then you can worry about the rest later through this structured loan, which I'd imagine U.S. Immigration Fund can offer. I would imagine that it's going to be their network of lenders.
I think that would probably be right.
Yeah, so it's an incredible business model. It happened to be a Kushner project that gets the first one of these, but I wonder if this is now a template they can use with all other developers. I would imagine that's the plan.
Yeah, and as you said, we're fascinated in things that have downstream effects on the real estate market. I mean, this thing goes through, and I think you're going to see a lot of projects get built because money's more expensive right now on the debt side. Construction costs have gone up. So if you can find a cheaper way to finance, that's how stuff's going to get built.
And this is all happening while the death of EB5 is coming up.
EB5 is dead. Long live EB5.
EB5 is dead. Long live EB5. That's it for the Promote podcast this week. The American Dream. It's now not just up for purchase, but can also be financed through a regional center near you. If that regional center is the U.S. Immigration Fund, of course. Men with deep pockets are stepping up all over the country and gobbling up buildings on basis.
And Taco Bell.
And speaking of gobbling, we're seeing a wave of M&A as AUM chases AUM.
It's fees and scale all the way down.
If you like what you're hearing and want to get in front of our audience,
a top 100 business podcast audience,
write us at partnerships@thepromote.com. That's partnerships@thepromote.com.
Like, share, subscribe.
Write us a review.
Help us get more broad.
You guys love this podcast. You're obsessed with it. Tell more people about it. As simple as that.
It's so simple.
Thank you, Will.
Thank you.
Ciao.